Welcome back. Time now for Michael Decter's top picks. Top pick on this day is Sun Life Financial, ticker symbol SLF on the TSX, and obviously one of Canada's big life co companies. Michael?
Yeah. First, we like their return on equity, which has been very strong, and we think they'll grow above their target. We like their 3% buyback. We like their strong capital position with $2 billion of essentially cash at the holdco level. We think it's a lower risk profile than its peers.
Okay. Surge Energy, number 2, ticker symbol SGY on the TSX.
Okay. Fundamentally, this time it's different in the energy patch. Instead of taking all the cash flow and drilling more wells and paying higher prices for land, they're actually dividing the cash flow, and Surge is generating good cash flow, and it's going to put a good chunk of it into the dividend and share buybacks and continue to grow production. So we like management and we like the positioning of the company.
That's a fairly common story among the Canadian oil producers now, that they've become more disciplined. They don't use their excess cash flow and profits simply to drill more holes in the ground and produce more oil, that they are very much focused on returning capital to shareholders. Why this one as opposed to many others in the sector?
They've had really, really good drilling results. They're into 2 of the best plays in Canada, including the Sparky, which we really like. So it's really, I mean, we own others. We own Whitecap, and some others, but Surge has really been a top player in the top plays, and that's what we like about it.
Okay, and do you think the oil rally has legs? We're at about 88, 89 today, I believe. So the rally that many people had predicted earlier this year has taken place. Do you see these strong oil prices remaining, persisting?
There's some seasonality to this trade, but yes. I mean, we don't know whether it's 85, 90. We'd be happy with anything above 75. We think these companies, including Surge, make a lot of money at that level, and anything above that is just icing on the cake.
Okay, let's go to top pick number 3, a familiar name to really any investor, Berkshire Hathaway, ticker symbol BRK.B in New York.
Yes. Well, let's start with the long term. From 1965 to last year, 19.8% per year, over double what the S&P did. And the S&P is one of your best bets in the world. So,
and that's a total return which captures both share price and dividend,
compound return. Right. In these times, Berkshire get called on to vouch for companies by buying usually discounted shares in them. They've got $150 billion of cash, more than many countries in the world, and they own big positions in some really good sectors and in big companies like Apple, Bank of America, American Express, Coca-Cola, Chevron. So you're getting a big bag of cash with Warren Buffett and his handpicked team investing it. And then you're getting some of the best companies, best run companies in the U.S. So, if I had to own only one stock, it would be Berkshire.
Wow, that's quite an endorsement. Michael, I want to thank you on behalf of our viewers today. Thanks for stopping by.
Great pleasure.
That is Michael Decter. He was our guest, obviously, on Market Call today. We look forward to greeting him again. We're in the home stretch. It's now time for top picks from Greg Newman. Top pick on this day, AltaGas, ticker symbol ALA on the TSX. Greg?
Yeah, listen, they continue to de-risk their balance sheet and grow their global export margins, strong utility growth, more delivering on the way, low cost of capital, high return, midstream growth opportunities. Just acquired natural gas facility from Tidewater, looks very high quality and synergistic. Low valuation, trades near 11 times and growing at around 11%. For a dividend name that we see growing their dividend at 5%, this name sets up very nicely in this environment with some good commodity tailwinds.
Those commodity tailwinds being the natural gas price, I assume.
That and the global exports that are coming that will be more robust, yes.
Okay. Number 2, the BMO NASDAQ 100 hedged to Canadian dollar ETF, play on the big tech index in the U.S.
Well, this is, people are asking, do you continue to own this area? Should you own this area after the big run that it's had? AI is going to be as transformative as the internet, and the Magnificent Seven are for real, and I think that they must be owned, and some of them are priced quite soberly for their idiosyncratic growth. Some are a little bit more pricey here, and so when you're buying this basket, you're getting some of the apples that are a little bit more pricey, but they've all come down. And you're certainly getting Google, Amazon, Meta, and NVIDIA in there in a big amount. And I do own those individual stocks, but given the carnage that we've had in the markets right now, I just think it's just easier. I like the fact that it's hedged, and in the meantime, you also get exposure to other names like Netflix, Adobe, Micron, Comcast, and some healthcare names in there as well that are, I think, sleepers and will add to the growth.
Why do you like the fact that it's hedged to Canadian dollar? You'd rather just set aside currency risk?
I want to set aside, I want to get the return as though you're investing in it as an American. I don't think that the Canadian dollar under 73 cents or around there is something that you want to mess with. I mean, I do think that is not really a Canadian dollar story as much as it is very strong US dollar risk off. Don't think that's going to last forever.
So as a professional investor, you've opted in this case to go for an ETF. What are your thoughts, or what's your advice to retail investors? When might they consider an ETF if they're looking at a particular number of stocks? If they're looking at tech stocks, wondering, should I buy Microsoft? Should I buy NVIDIA? Should I buy Apple?
Yeah.
What's the case for buying an ETF instead?
Well, I'm all about being efficient. I just want to do the right thing at the right time to try to score as much points as we can with as little risk as possible. So there's times, where Amazon is the darling of those 7, or you don't want to own any of those 7. And there's times when, even though this is a great long-term asset, it's probably got more downside than upside. I think it's a tool, and when you can use it to make money with as little risk and spread it around, I think that's when it works.
Okay. And the last one, back to cash, 1 year annual GIC.
Yeah, I think dividend stocks here are a great deal. So is technology. That's why they were 2 of my first picks. But, and I don't think we're going into a bear market, but I think that you want to stay on your asset allocation. And I think that when you get yields as high as they are right now, and you can get them 5.5 plus, 5.8 1 year annual, that is something to hang your hat on, and you're getting paid really well to be safe and take off some risk in the portfolio.
Those are Greg Newman's top picks: AltaGas, the BMO hedged to Canadian dollar NASDAQ 100 ETF, and a 1 year GIC. We're going to sneak in a bonus question here. We had an email that we were not able to get to earlier from Edward. Edwards asked this question: what effect has the cycle's low and negative interest rates had on pushing back a recession? How does it contribute to the soft landing narrative?
Can you scroll back a little bit? Wait.
He must be referring to the earlier negative interest rates, which were back some time ago, and the earlier low interest rates. He's asking, might they play a role in the soft landing narrative that investors are hoping for right now? There it is on the screen.
The negative interest rates that we had pushing back on a recession, how does this contribute to the soft line? And I'm not sure. I'd have to take a better look at the question to really understand what the viewer's trying to get at there.
Yeah, interest rates obviously are not low right now. The narrative is higher rates. Greg Newman, thanks a great deal for joining us today.
Thank you
we look forward to having you back. Let's start in with Darren Sissons' top picks on this day. Number 1, British American Tobacco, PLC, ticker symbol BTY. In New York. Now, here is a bold pick for reasons perhaps to do with things other than finance. Why do you like British tobacco?
Yeah, so, we're dealing with that. The transition to heat, not burn consumables is really pushing a little bit back against the obviously this the underlying pushback, the ESG. But effectively, what you're looking here is this is just a clear mean reversion trade. Historically, this traded sort of between 4.4 and 6.8. At a 9% dividend yield, you only have to wait 8 years, and every dollar thereafter in return is playing with the house's money. And so if you're in a recession, income is a scarce commodity. So getting 9%, I think is very attractive at this point. And there is underlying growth. The company is going to do a buyback probably next year. So at this point, you may not like the underlying product, but there's a significant cash return that you can get just by holding it. And it will give you good ballast and downside protection.
Okay, and the company's not trapped in a declining market.
Well, that's the whole transition to the consumables, the heat not burn. And, the world is still consuming tobacco in large swaths.
Okay, let's go to number 2, another very familiar name in the Canadian energy space. Many consider it to be the flagship, Canadian Natural Resources, ticker symbol CNQ.
Yeah, so CNQ, like its large cap brethren elsewhere, is just hemorrhaging cash. So after the dividend, they've got $11 billion available in terms of free cash flow. $5.5 billion worth of buybacks this year. I think there's $12 billion worth of debt on the books as of June 30th. Once they get below 10, 100% of free cash flow is going to be returned to shareholders. So at current levels of oil, this is going to be a very rewarding opportunity for Canadian investors and perhaps international investors who want to look at getting some exposure to companies that are just printing cash right now.
Okay. And number 3, the final top pick on this day, Johnson & Johnson in the healthcare sector, a benchmark stock there, J&J in New York. Yeah,
so the first 2 picks were really income-oriented in terms of mean reversion. Now, this is a growth story, and I think it's an unusual thematic. So previously, the company had three legs to the stool. There was the consumer business, the pharmaceutical, and obviously the medical devices. The consumer business was split off in terms of, and it now trades under Kenvue. I think it's about a $62 billion market cap. But now the company can focus on the remaining 2 businesses, which had a higher growth profile. And obviously, if that is executed effectively, you will see further growth and a re-rating in the stock. It's a dividend aristocrat. I think it's paid a rising dividend from memory for 62 consecutive years. So at these levels, if you get growth in an environment that's not expecting it, i.e. a recession, that will perform quite nicely. And if you hold it long term, we know the history. It's done very, very well.
Those are Darren Sissons' top picks: British American Tobacco, BTI in New York, Canadian Natural Resources, CNQ in Toronto, and Johnson & Johnson, J&J in New York. Darren, thank you a great deal on behalf of our viewers for your time today.
Thanks for having me.
It's Darren Sissons. We welcome him. We look forward to welcoming him back before too long here on Market Call. Time for top picks now with Ryan Bushell. Fortis is number 1 today, ticker symbol FTS on the TSX.
Yes, I mentioned earlier, there's a lot of good dividend-paying stocks on sale. This is probably one of the best. I think Canada's longest track record of consecutive dividend increases. They just hit 50 years in September, so congratulations to them. You can see there on the chart, down from $60 even earlier this year, so that's a nice 15-ish% decline. But this is a company that's got staying power for as long as the eye can see, and so if you're getting it off the top level, it might go lower from here, but you're getting a 4.5% yield with roughly 3 to 5% dividend growth baked in for a very long period of time. So when good stocks go on sale, this is the time to buy them, and this is a holding that we have had in portfolios for decades, going back to my previous firm, and hope to have for decades going forward.
Okay, there's a strong endorsement of Fortis. Algonquin Power, number 2, AQN on the TSX.
Yeah, so a little more controversial, and it's rebounded. When I wrote this earlier this week, it was trading at $7.25, and I looked at it and I just said, look, this company is not that different from where it was 2 years ago when it was $20. So at $7, you better like it. It's still 2/3 regulated utilities, including water utilities, which are the best kind of utilities. They did not do the Kentucky Power acquisition, so the debt, what people were worried about on the debt side is not coming to pass. I know that they're in the process of potentially selling their renewables business, and that may or may not close. And that's probably what's pushed the shares down. There may even be another dividend cut coming, but at the end of the day, today, those assets have more value than what is being priced into them at current levels. And as I said earlier, if you're willing to step in when others aren't on a regulated asset that is going to persevere, the path is up from this share price, and that's how I feel about it.
So the market clearly lost confidence in the company and management last November when I believe it missed expectations badly and revised down its guidance. Did it also cut its dividend then? Or we should bring back the one-year view, please, of Algonquin.
It was January when they cut the dividend,
right.
Following a review, and there was some toing and froing on whether they were going to do that acquisition or not. So the share price had already come off at that point and made some lows in January. Now it's making new lows, and I, other than the recent rise in rates affecting all dividend-paying stocks and people just selling them, selling the passive utility ETF, right, and this being a part of that, so everything gets hit when those more macro, shorter-term players sell out of passive positions like that. But again, if you're active and you know the value of what the underlying assets are, that's when you have to be on the other side. For every buyer, there's a seller. For every seller, there's a buyer, right? So the buyers that are buying at current levels, I think, will be pleased looking back on a longer-term basis.
Okay, and the final top pick on this day, TC Energy, ticker symbol TRP on the TSX, obviously one of Canada's pipeline giants.
Yeah, so given what's going on, I can't stray too far from the utilities and energy infrastructure sectors. Talked about TC earlier and their exposure to natural gas and natural gas feedstock for LNG liquefaction. Coastal GasLink finally coming to completion here, I think in Q4 or at the latest, very early Q1. That'll be a bit of a monkey off their back. Clearly, people were not impressed with the financing plans for future growth that they put forward earlier this year. But again, the financing plans are for future growth. It's not for future shrinkage. So in my view, again, you're getting, I think, an 8.20 yield on TC Energy right now. We'll see. I'll measure that up against Apple 5 or 10 years from now, and we'll see how we do.
Ryan Bushell, thank you a great deal for being with us today.
Thanks for having me. Appreciate it.